I wanted to record a quick video today. We're going through a bout of volatility, and volatility is never fun. But I thought today I would record a video just with two things in mind. One is a quick reminder that volatility is the price of admission for investing in the stock market. And the second is I've got some charts and thoughts about the last couple of days of volatility we've seen in the market. One of the things that I wanted to show is a chart of all of the drawdowns that we've been in through Friday's close since 1950. And right now we're in a 17% drawdown from the all-time highs that we saw earlier in the year. And when we look at a chart of everything from 1990 through today, many of you have seen this chart before. This is what the S&P 500 ended the year at the end of each year. And then the red diamond is how far down during the year we saw a decline. This year, we're down 13.4% on the S&P 500, down 17.3% from the highs. It is important to acknowledge that we had two fantastic years the previous 2 years. So all told, it is a tough year coming off of two fantastic years. We looked back at every 5% or greater drawdown from 1950 through Friday. And we are definitely higher than what a normal 5% drawdown has turned into in the past, but not in a significant decline like we saw in the financial crisis or the dot-com crisis. One of the things that's important to remember when investing in the stock market is you're taking all of this risk and volatility for a reason. If we look back at 100 years of data, this is going back to 1926, investing in the stock market and dealing with all of these ups and downs. I'm just going to use the US large cap on the screen as an example, which is a proxy for the S&P 500. $1 would have grown to $18,000 over that 99-year period. If you contrast that to the safer, less volatile investments like cash or government bonds, there is a significant premium over time that you've earned for taking the volatility and risk in the stock market over that period. When you go and back inflation out of those numbers, it really paints a picture of why you're putting yourself through these ups and downs and all of the emotions that come with it. Sitting in cash, this is mattress money or cash you have sitting in your safe deposit box, $1 would have grown to $1.37 over that period. Putting the money in bonds would have grown to $5.92 over that period. $1 would have grown to over $1,000 inflation adjusted over that period. And that's the whole reason you're doing this, putting up with these very painful days and weeks. It's important to remember that this isn't an all or nothing decision. I have on the screen just highlighted the one thing that I'm talking about today, which is 100% stock portfolio. Your mix may be 60% stocks, 40% bonds with lower historical returns, but also lower volatility along the way. And that's what you're experiencing right now in your own investment portfolio. Along the way, there's always going to be some sort of headline risk. Right now, we're talking about tariffs. If we look back throughout history, there's always some reason to be worried. There's very rarely an all clear signal. I don't know what we're going to be talking about next year or the following year or the following year. There's something that no one is talking about that will pop up, and we'll deal with it just like we've dealt with everything in the past. One final thing to think about when thinking about long-term investing is this chart from a company named Dalbar. What they did was they plotted 20-year annualized returns ending in 2021. I'm pointing at the S&P 500 right now. Over this period, you would have earned 9.5% for dealing with all of the ups and downs that came during that period. We've got part of the dot-com crisis, financial crisis, COVID, all baked into that picture. If you wanted to have taken less risk during that period and mixed 40% bonds in the portfolio along with that 60% stocks, it would have been 7.4%, 40% stocks, 60% bonds, 6.4%. The most eye-popping number here is what the average investor did over that time period. There are a few different reasons for this, but one of the main drivers that we see is the behavior that some people exhibit, primarily panicking and selling when things are really scary, and then waiting for the all clear to get back in and get invested. Over that time period, inflation averaged 2.2%. So you did make a little ground, but not a lot. I don't imagine anybody falls in this 3% category that is watching this video, but it's a good reminder that sometimes we are our own worst enemies. What we did over the last couple of days is looked at what have we seen on Thursday and Friday. So on Friday, the S&P 500 was down about 6%, and on Thursday, it was down almost 5%. We plotted out the daily returns for the S&P 500 going back to 1950 here. You'll see three major periods of down markets. You've got Black Monday in 1987, you have the financial crisis, and then you have COVID. The interesting thing is you also see a lot of other periods where the market was down 5% or more in a single day. It feels different this time. History is showing us that sharp daily declines are part of the cost of admission of being an investor. The other thing that is very apparent is up days are clustered with down days on this chart. You see sharp down days, you see sharp up days, all in a very short period of time. That's why timing, getting in and getting out, making all in, all out decisions are so challenging. What also was fun to look at was the last 2 days of returns. Not fun at all from being invested during this period, but from just a pure data standpoint. We were down 10.5% on Thursday and Friday combined when you compound the returns together. That puts us in some pretty rare territory. We looked at all of the 9% or greater declines going back to 1950, and we only see 1987, 2008, and 2020. So Black Monday, the financial crisis, and COVID are the only other periods where we had these significant 2-day declines. If we look out 1 year from now, using past history as a guide, over every single one of those 2-day declines that were 9% or greater, the lowest return a year forward was 9.1%, with some pretty spectacular returns as well. If we look out 3 years, 5 years, or 10 years, the numbers get even better. And we just summarized these on an average basis as well. If you're looking for some positive news looking forward into the future, this is a very welcome chart to look at. The second thing that we did was we looked at the volatility index, also known as the VIX. This is sometimes referred to as the fear index, and it measures the volatility of the S&P 500. We did see a spike in volatility on Thursday and particularly on Friday. We are not at the levels of volatility we saw in the financial crisis or COVID, but you do see that we've spiked above 40 on this chart. And so what we did was we went back and mapped out the different ranges that we've seen in the VIX. So starting on the left, VIX levels below 11, and then increasing by 1 all the way until we get to 36 or more on the right. We are currently sitting at 45 on the VIX, so very elevated volatility and fear in the market. This chart's just showing over the next month, what have the average returns been when the VIX is sitting in any of those ranges. So over the next month, not a lot of dispersion of returns here. You can see on the right-hand side, higher levels of the VIX, higher levels of fear in the market have had higher average returns. But where it gets interesting is if we start looking out 3 months later, you see those bars on the right-hand side larger than the left-hand side when there's less fear and uncertainty in the market. 6 months out and 12 months out is a very interesting and hopefully fun number for anybody who is watching this. There are definitely periods when you experience negative or lower returns, but seeing that the average return 1 year from when the VIX hit 36 or higher is 29.7% should hopefully be a comforting number to see. Wanted to keep it short and sweet today. Certainly, if you have any questions about any of these slides, or we've got a ton of others, or you'd like to talk about your portfolio, we'd love to chat with you. Please reach out.